Welcome back, dear students and scholars. In video 1, we identified operating segments using the management approach and the chief operating decision maker view. Now we move to the next question. Which operating segments become reportable segments? ASC 280 uses three 10% tests, a 75% external revenue coverage test, aggregation judgment, and comparability rules. This video will walk through those tests with one 6-segment illustration so the logic stays connected instead of becoming a pile of disconnected formulas. Start with the full sequence. First, identify the operating segments. Second, use the same measures the chief operating decision maker uses internally. Third, consider whether permitted aggregation is supportable. Fourth, apply the three 10% tests: revenue, profit or loss, and assets. Fifth, check the 75% external revenue coverage test. Finally, decide whether the reporting is useful and comparable across periods. If you skip a step, the conclusion may still look neat on paper, but it can be wrong. The numbers used in ASC 280 segment testing come from the internal reporting view. This is important because segment reporting follows the management approach. We do not automatically start with consolidated GAAP net income or consolidated external reporting categories. We start with the segment information reviewed by the chief operating decision maker for allocating resources and assessing performance. Once a profit or loss measure is selected, it must be applied consistently across all segments and the measurement basis must be disclosed. Aggregation is permitted only when similarity supports it. This is not a shortcut for reducing the number of disclosures. Segments may be combined only when they have similar economic characteristics and are also similar in areas such as products or services, production processes, customer types, distribution methods, and regulatory environment. Think of aggregation as a disciplined judgment, not a presentation preference. If two segments look similar only because management wants fewer tables, that is not enough. There are three 10% tests: the revenue test, the profit or loss test, and the assets test. The key memory point is that this is an OR structure. A segment does not need to pass all three tests. Passing any one test is enough to make the segment reportable. Failing all three does not prohibit voluntary disclosure, but it means the segment is not required to be separately disclosed by the quantitative 10% tests. The revenue test uses total segment revenue, that means external customer revenue plus inter-segment revenue. The ratio is segment total revenue divided by combined total revenue of all operating segments. If the result is at least 10%, the segment passes. Be careful here. The denominator is not only consolidated external revenue. Inter-segment revenue is included consistently in both the segment amount and the combined operating segment total. The profit or loss test is the easiest place to make a mistake. First, add the profits of all profitable operating segments. Second, add the absolute values of all loss segments. Third, choose the larger absolute amount. Fourth, compare each segment's absolute profit or loss to 10% of that benchmark. A segment with zero profit does not pass this test because zero is not at least 10% of a positive benchmark. Loss segments can pass because losses are tested using absolute value. The assets test compares segment assets with combined assets of all operating segments. The ratio is segment assets divided by combined segment assets. If the result is at least 10%, the segment passes. Use the assets that the chief operating decision maker reviews for that segment and do not inflate the denominator with general corporate assets that are not assigned to operating segments. This test is especially important for capital intensive segments that may have modest revenue or profit but hold significant assets. Now we apply the test to 6 operating segments. Segment A has total revenue of 320, external revenue of 300, profit of 40, and assets of 200. Segment B has 220, 200, 15, and 160. Segment C has 150, 140, 9, and 90. Segment D has 90, 80, a loss of 30, and assets of 80. Segment E has 100 revenue, 0 profit, and assets of 60. Segment F has 60 revenue, a loss of 5, and assets of 40. The combined revenue is 940, external revenue is 880, and combined assets are 630. For the revenue test, the threshold is 10% of 940, which equals 94. Segment A passes with 320. Segment B passes with 220. Segment C passes with 150. Segment D fails with 90. Segment E passes with 100. Segment F fails with 60. So after the revenue test alone, A, B, C, and E are reportable. D and F still need to be tested under profit or loss and assets. For the profit or loss test, combined profits are 40 from A, 15 from B, and 9 from C, giving 64. Segment E has 0 profit, so it does not enter the profitable bucket. Combined absolute losses are 30 from D and 5 from F, giving 35. The larger benchmark is 64 and 10% is 6.4. A, B, C, and D pass because their absolute amounts exceed 6.4. E fails because 0 does not pass. F fails because 5 is below 6.4. For the assets test, the threshold is 10% of 630, which equals 63. Segment A passes with 200. Segment B passes with 160. Segment C passes with 90. Segment D passes with 80. Segment E fails with 60. And segment F fails with 40. Notice the important result. D failed the revenue test, but it passes both the profit or loss test and the assets test, so D is reportable. Segment F has now failed all three 10% tests. After the 10% test, we still apply the 75% external revenue coverage test. This test uses external revenue only. The ratio is reportable segment external revenue divided by total external revenue of all operating segments. If the result is below 75%, management must add additional operating segments as reportable until the required coverage is reached. This test prevents too much of the entity's external revenue from being buried in the all other category. In our illustration, reportable segments are A, B, C, D, and E. Their external revenues are 300, 200, 140, 80, and 100. That totals 820. Total external revenue for all segments is 880. The required minimum is 75% of 880 or 660. Actual coverage is 820 divided by 880, which is 93.18%. The test passes, so segment F does not need to be elevated to reportable status. Even when a segment fails the quantitative test, management may still disclose it separately if that information is useful to financial statement users. Segment F failed revenue, profit or loss, and assets, so it is not required to be separately reported. But management may voluntarily disclose it if there is a defensible usefulness rationale. The keywords are defensible and consistent. Voluntary disclosure should not become a tool for showing favorable segments this year and hiding them next year. Segment determinations are not mechanical forever. Each reporting period requires reassessment. A segment that was useful to disclose in a prior period may continue to be separately presented when that supports comparability. Current period tests must be recalculated using current data. Expected future significance can also matter in judgment. And if internal reporting structures change because of reorganization, acquisition, or divestiture, prior period segment information may need to be restated when practicable. More segment detail is not always better. ASC 280 is designed to improve transparency, but too many segments can create confusion instead of clarity. Too little detail hides risks and masks performance differences. Useful detail explains the business in a way that users can analyze. Too much detail creates clutter and dilutes the message. As a practical warning, more than 10 reportable segments may indicate excessive disaggregation, although this is not a hard numerical ceiling. Use the decision tree as a working checklist. First, confirm that the component is an operating segment. Second, identify the measures used by the chief operating decision maker. Third, consider whether similar segments may be aggregated. Fourth, apply the 3-10% tests. Fifth, apply the 75% external revenue coverage test. Sixth, assess usefulness and comparability. This sequence helps prevent mechanical errors and supports a defensible segment reporting conclusion. The common calculation traps are exactly the kind of small errors that change the final answer. Do not ignore inter-segment revenue in the revenue test. Do not use net profit as the profit or loss benchmark. Do not forget absolute values for losses. Do not skip the 75% test after the 10% test. And do not aggregate segments just because it makes the footnote shorter. ASC 280 requires both arithmetic accuracy and disciplined judgment. Let us close with the memory map. Start with operating segments identified through the Chief Operating Decision Maker reporting view. No aggregation is applied in this illustration. The revenue threshold is 94, so A, B, C, and E pass. The profit or loss threshold is 6.4, so A, B, C, and D pass. The assets threshold is 63, so A, B, C, and D pass. The 75% test passes because 820 of 880 external revenue is covered. Final result, A, B, C, D, and E are reportable and F is non-reportable. In video 3, we move from testing to disclosures, reconciliations, IFRS and SAP perspectives, and practice questions. Please like this video, share it with your colleagues, subscribe to Commerce Regiment, and support the channel so we can keep building structured US GAAP education.